So welcome, everybody. I'm Patricia Haas-Cleveland, as you probably know, President of OMSIF US. We've got a great panel here today to talk about central banks, digital assets, and the future of money. Let me introduce the group. We have Antoine Martin from the New York Fed, who is Senior Vice President for Financial Stability. Jens Reich, who is the Chief Representative for the Bundesbank. Next to him is Brian Whitehurst, who is Head of Regulatory for Luca. And last but certainly not least, we have Nitin Gaur, who is the Global Head for Digital Assets, Technology, and Design at State Street. So we've got a great group in terms of different perspectives, which I think this topic requires. Basically, we'd like to talk about the landscape and the regulatory developments that have been dominating the headlines, certainly in the U.S., TradFi, innovation and technology, and the role that those topics play. And then last but not least, linking into our overall conference here, financial stability and what does the future of money look like. So to begin, just to say we've seen an increasing place by digital assets entering into the mainstream. It still may be seen relatively modest, but it is quite noticeable, whether it's cryptocurrencies, tokenized assets, stablecoins, or CBDCs. They're moving in alongside traditional assets, which has created a lot of challenges for the financial industry, which is not only transforming to a digital financial industry, but is also intersecting increasingly with the world of decentralized finance. Investors are trying to figure out how to integrate these new assets in their portfolios, how to have systems to manage them, while new entities entering the fray, finance, fintech or technology companies, as well as traditional finance firms are trying to figure out what is allowed and what is not allowed, and regulators are grappling both with the new entities as well as traditional finance firms trying to figure out how should these activities and participate regulated. So it's quite a complicated picture. And to start with, I'd like to go over what the financial landscape is in terms of digital assets. We've got Antoine, who's going to give us a tour, at least from the U.S. perspective, which is probably most controversial. These days, we went from a relatively neutral or agnostic government view when the White House issued its executive order to put together a regulatory framework, or at least an approach, to becoming less agnostic and more negative after FTX. We've seen the SEC ratchet up its rather aggressive enforcement actions. We've got now leading players suing the regulators. That's rather a new development. And the Hill is trying to put together proposals as to how to regulate this sector. So a lot going on. Maybe you can tell us how you see it and also what you think the major risks are to financial stability from the emergence of this area.
So I have to make a few first. So everything, of course, on my own view. And of course, as a Fed employee, a Fed staff, I'm not well placed to comment on SEC decisions. In addition, as President Harker mentioned yesterday, the Fed is really not the obvious regulator to look. That said, I can speak as a researcher with a background in payment economics, and I think that there is a huge amount of fascinating things happening here. I think what I would say, in general, I subscribe to the idea that if assets or activities have similar risk, they should be regulated in fashion. And I think the onus is on the people who claim that they are going to be changing the way things operate and make them better to convince regulators that this is indeed the case. So sometimes, not always, but sometimes the call for regulatory clarity is an effort to get less regulation so you can sort of do things that you want. And I don't think that regulators should just sort of accept the claims of these institutions that they're going to revolutionize the financial system without some kind of evidence that this is. doing something good. That said, and I think this is what President Harker said yesterday, we would like to have an environment where people who have good ideas and can make a positive difference are able to set up businesses that can thrive. And so it's important to have that foundation. There is a sense in which a lot can already be fitted into existing, and I would go back to saying that in my personal view, the onus should be on innovators to why it is that they do something that's that deserves a different treatment rather than just sort of saying, hey, just
they are unable to get that kind of clarity. And I appreciate that President Harker did say it's not up to the Fed to create these rules, it's up to Congress. And for those of you who watched it, or if you missed it, there was an amazing exchange between the chairman of the House Financial Services Committee and the chairman of the SEC, which got quite heated because there are innovators who want to offer new products and services, and they can't get the clarity they need. And that exchange was all about, the definition of a security or a commodity, and asking for clarity on that, and that was not provided. So it is a tough going around in circles at this point in time. But I do think some of them are trying to get that sort of clarity.
So I don't want to get out of my lane too much, but one interpretation of these discussions is that the SEC says, well, it is clear, you're a security. And people say, no, it's not clear, because we don't want to be a security. And so the problem is not clarity, it's disagreement about what you really are. And so again, I think it's, if these people can convince the SEC, then I think, but it's not obvious to me that this is an issue of regulatory clarity as much as disagreement.
We could go on and on about this one, but it was a clarity question because they specifically asked about a particular item, and he would not say. But anyway, let's move on from the U.S., where I think we can all agree there is still a lot of work to be done, and I know there's a lot of work underway. But Jens, tell us about Europe. MiCA was formally and finally passed all the hurdles a week or so ago to enact its new legislation to really be very comprehensive around digital assets. Can you tell us a little bit about that? And also, we've seen the UK move ahead on a potential sterling pound, digital pound. We've got a euro digital currency in the works, UK regulatory proposals around crypto. Tell us about what's going on in Europe and what are the key takeaways that you see from MiCA?
Again, usual disclaimer applies. And to let Antoine a bit off the hook, I would say one sentence on the US. I mean, I do see some merit in creating regulatory clarity in the sense that the way enforcement works means that the SEC and the company by company sometimes thereby try to reach clarity. I would say that there's some idea in having a regulation, and surprisingly, I might say, we have one in Europe. And because when I was raised, the idea was kind of Europe is a complicated place, and it's so much easier if you have one federal government. But sometimes it seems to around. And I mean, MiCA was created basically in the light of Facebook and Facebook's plans around Libra, Diem, whatever they called it. And that's maybe why you will have parts in MiCA which will maybe never apply. Like we have the distinct different types of stable coins in there. One is e-money tokens, which would be something like in the US, Circle's USDC. You have a coin which is based on one currency. Also have the ARTs. I think that's a wonderful term, the AST reference tokens. You would have explicitly the idea that there's a bundle of currencies used as the basis for your stablecoin. And I don't know if this will ever grow anywhere, but we have it in there. So that is surprising. I mean, the huge difference, I think, between the US and Europe is that while we have a regulation, we don't have an industry. So there is no market for I mean, there are some stable coins, but if you compare it to the US, I mean, it's really small. So while I think the regulatory clarity we do have, and I mean, there's some implementation to be done, like Mika specifies that you are asked if you want to have a stable coin to have reserves and stuff, but which reserves, which assets, that still has to be determined, and that's work in progress. But I think that is, you also raised the question of CBDC, of central bank digital currency. That's also one of the reasons why we might be more active on that front in Europe than we are here in the US. If you think that there is a use case for a token which can be used for settlement purposes or whatever, you could use, like Coinbase does in the US, you could use Circle's USDC. But in Europe, what do you use? I mean, we have a huge reliance on American corporations in terms of MasterCard, Visa card. So in the payment sphere, already we have a huge dominance of US-based firms. There is no huge euro stable coin which you could use. So somehow it makes sense that this gap is filled by authorities. And that's, I think, why we have a huge progress on the front of in Europe. And I mean, I can go into this if
I'd like to just stop a bit on stablecoins, though. That's one of the issues that I know the Congress is debating right now about allowing banks and non-banks to issue stablecoins. I don't know how that will play out, and Antoine, you might have a view on that. How does that addressed in MiCA?
Well, in the first place, kind of, if you want to have a stable coin, you would have to go to the regulator and tell the regulator you would want to do it, and he would have to say, yes, you're allowed to do it, and then he would impose requirements, which I said are still work in progress. So the final result on what you have to have will be set up. But for example, if you want to do it, you treat it like a payment service provider, and a little more strict than usual payment service providers. So you would have to have equity. You would have to have, and equity depends, like there's a minimum threshold, I think it's 350,000 euros or 2% of the assets you have, that's already determined. But there would be set up more in terms of what reserve do you have to have, what assets can you use as a reserve, and so that you would really have like requirements set up. And MiCA, which I like also very much, is you could also identify certain of these tokens as significant. So like we have it in the banking sphere or in other spheres where we would identify a bank as systemically important, we would have significant tokens which we could treat even more with even.
Can it be banks and non-banks?
Yes.
Okay.
So yeah.
And just before we, the market cap exceeding $1 billion is pegged to the US dollar. Does that affect the way you think about stablecoins? And
I think that's really about the role of the dollar and not about stablecoins. And so this came up in panels. So that if you have bigger stablecoins, you have to, and so we have the fact that a lot of stablecoins are, well, that also sort of suggests happening but yeah, it should.
Let's turn to Brian for a second, moving down. A lot of the discussion is all about defining. There are actually a lot of other issues that you see, Brian, that are out there.
I think regulators need to understand that these assets go beyond just their classification as either a security or commodity. There is a future that we're going to have to grapple with, where their function has far-reaching effects beyond just their typical high-level classification. So it's important to understand how these tokens actually function, what their purpose is, how they're built into the ecosystem, and what they can provide to the financial systems. At Luca, we have developed a classification system similar to GICS, where we drill down to the real functionality of all these tokens and have a better understanding of how they work in the entire environment. So I think it's important for regulators, as they're building out regulatory frameworks, to have this understanding and not just do a high-level overview of, yes, this is security, yes, this is commodity. Because the reality is, I think as Ether has shown, that can change. And if we don't build in processes within any regulatory frameworks to adapt to that change, it's going to cause more problems down the line. So I think regulators need to work on that level of understanding, which in some jurisdictions, they are not necessarily the U.S. I think in Australia, they're taking that approach to really do a full taxonomy of the entire ecosystem at the asset level in order to properly build the regulatory frameworks, which I think a lot of other jurisdictions would benefit from following.
And I think when we were chatting the other day, you were talking about implications for just very practical issues like accounting, taxation. As you deal more in this sector, these are all aspects that are critical, not just the definition and classification.
Yes, absolutely. So one thing that I know regulators and just generally people don't fully understand is the balance between what is labeled as security or commodity versus what accounting boards and tax authorities actually classify these as. So Bitcoin, Ether, no matter what, like the IRS classifies it as property. And for any entity holding it on their balance sheets, they need to understand the accounting rules to make sure that it's not thrown off. And so I think as regulators are building out new frameworks, they need to work with accounting and tax authorities to understand that mechanism, because while a company might be investing in Bitcoin, if they don't fully understand that aspect of it needs to be property on their balance sheet, and it goes to a different area, they're going to get hit. So, and I think that draws out into as CBDCs are developed, how CBDCs are going to be classified, and that understanding of it becomes property. So if you're dealing in it or operating in it, and if a CBDC is used to buy a pizza at some point in the future, that is viewed as a different purchase and as a taxable event under current regulations, which needs to be ironed out, because it can't be that every time you use a CBDC or cryptocurrency to make a purchase of any way that it is now a taxable event. It's just not prudent. So
that sort of highlights another point, which is not only taxonomy of the industry, the accounting, the taxation, but also cross-border, and how important is it to, head towards some sort of international understanding of standards and practice. I know that the G7 in Japan announced last month in May, noted that they were committed to effective regulatory and supervisory frameworks for crypto assets and markets, as well as stablecoin arrangements, et cetera. So I think they also heightened the importance of solving for this, and also ensuring that there's a certain amount of compatibility and interoperability. So I don't know if you want to add anything to that.
No, I mean, I think the better understandings as regulators are grappling with it is making sure that they're looking at the full ecosystem, thinking about the smaller details. Because the realities are, like, as much as everybody wants to compared to traditional finance. These things are functioning in different ways, and they span a broad array of asset classes, not just necessarily like single individual ones that it's often talked about. So it's important for them to think at a higher level in a different way than normal traditional finance. You don't see securities trading against commodities in the normal traditional markets. So how are you going to grapple with that? I can understand, same risks, same regulatory frameworks, but there has to be the acknowledgement that it is a different way of doing it. So because it's a different way, it requires slightly different regulatory frameworks. So as the G7 and G20 are looking at these and regulators around the world, it's vital that they are evaluating it in a slightly different way than the traditional markets.
Said that, let's turn to the role of traditional finance, because traditional finance firms were originally viewed as the disrupted. They were going to get wiped off the map and replaced, but now they are starting to take a lead in both innovation in terms of products and services, but also in upgrading their own internal structures and systems to be able to participate in this ecosystem. So Nitin, I want to turn to you on that note and tell us about the role that traditional finance firms can play and what you're doing at State Street in terms of both internally modernizing as well as the kind of demand you're seeing externally and how you're planning to respond to that.
Yeah, so the views of my own, as the normal disclosure goes. So a few things. The way I look at the industry, and I've been doing this for quite some time, trying to understand the disruption the technology has, because in essence, it is disruptive. The tech itself is meant to be disruptive. And what started out 14, 15 years back with Bitcoin and now has morphed into what once was a $3 trillion economy and now it's 1.x trillion economy is, one is, if you look at our business in general, this is largely most financial institutions, I view this as three swim lanes. The first swim lane is we have to provide cash services, we have to provide traditional financial services, even to the Coinbases of the world. So they need fund accounting. You have crypto funds who need fund accounting services. So that's traditional business. There's nothing exciting about it. It's BAU. We need to have the same level of players and providing these different services. And if I were to go and describe the remaining two swim lanes into a political spectrum, so far left, again, is crypto in general. What do we do? So we fall back to, which is happening with most financial institutions, fall back to what we've been doing and what we understand is things like custody, things like providing us, our ability to be able to deal with crypto, as an ETF or as an asset class on its own. And that's where the whole conversation on regulatory clarity comes into effect, is what do we do? Can we custody it? And again, post-Jan 3rd conversation on the safe banking practices around blockchain or public blockchains, it really puts most financial institutions at crossroads to say, what do we do with this asset class? What do we do with dealing with public chains? And also for, all for the right reasons, because there's a strict, I've been building tech systems for financial institutions for the longest time. There's a massive scrutiny on scalability and resiliency of the systems because they actually have dependency on our economic system. So you cannot rely upon, in the name of decentralization in general, to say, hey, this is decentralized, so it's resilient. We have to have some guardrails and someone accountable for these things who is expending their acumen and time to build these systems in general. And then you have the far left use case, which to me is super interesting, and I'll opine on this a little bit with a longer perspective, is modernization of existing financial system. I think we all have seen, have known things like reconciliation, things like that should happen quite quickly, takes forever, and you have people, time, process, technology, investments in simply doing things. And this is only getting worse because the volume of transactions are simply going up simply because things are getting more digital, whether you're looking at retail or even going towards wholesale side of the house. So I'm looking at this as an avenue to modernize the existing financial system, is looking into saying what are existing at a very basic level transaction systems and what can we do to take blockchain to implement them into figuring out the modernization play, which solves the issue of, I would say, time and trust are the two constructs, that this is what blockchain solves. Time, again, has implications on liquidity. Time has implications on, the value of locked capital because it's in transit. And trust is essentially the whole series of financial institutions that's providing this collective services. Essentially, is the fragmented trust model that we have today. And if we can embed in the protocol, we can do a lot. So we don't have any more information intermediaries because internet solved that problem. We still have new intermediaries, but we don't have travel agents anymore. We have digital travel agents. So I have a perspective to see who are the existing financial intermediaries, and if we were to implement this notion of trust using protocols, there'll be new financial intermediaries. What does that world look like? So I'll pause here to see if that made sense.
I mean, the advantage that traditional finance firms have is that, A, they're regulated. So as more people enter this business, they may feel safer gravitating to those entities. But on the other hand, they may not be as innovative or offering the same sorts of products and services that are coming out of these newer entities. So it is a challenge to figure out how all these pieces fit together. And from your perspective as a regulated entity, you find, and this question of regulatory clarity, when you, in addition to sort of modernizing your internal system, you find it's challenging to figure out, okay, we've got this technology, wow, it can do all these things, but are we allowed to do all these things? I mean, how do you cross that bridge?
No, I think it's brilliant, and I spend all my time looking at what does that technology design look like. So, for example, if you're looking at tokenizing a specific asset class, who are the market participants, who are the market players? And I've taken the approach to say, let's keep the existing market infrastructure the same, which means that we need to understand elements of what does it take to tokenize an asset, whether it's an ETF or gold or bond. What is the flow? Who are the market participants? What's the settlement cycles that we need to, and from regulating or understanding the regulatory framework around that asset class. So by preserving the market infrastructure, you aren't disrupting a lot. You simply increase velocity, which is the conversation I was having with Karthik early on, is essentially you're building a transaction system that provides an essence of real-time movement of assets. And that has implications on not just economic system, but also the way we have done accounting in the past, calculations that happen behind the scenes. So you just want to understand what is the implication of fixing one end of the equation and not addressing the other end of the equation. It becomes has to address all of it in one single swoop. So what we've taken the path to say, let's keep the existing cycles, let's keep the existing settlement times, but slowly build the rails, which is the infrastructure play. And once I build it, I have 3 I's, which I constantly talk about in every event, is build the infrastructure, preserve the existing market infrastructure, so we're not dealing with any of the other elements of regulatory clarity on the asset class, everything remains the same. And then figure out as to the next I is the instrument, is what is the framework around, let's say, a ETF or a bond or a gold or equities and so on and so forth. The third thing is, which is where things become interesting from a tax and accounting perspective, is insights. Because you'll find that there's massive amount of data being created, and the accounting systems are not equipped to handle the velocity and the formatting of the data that they're used to. So these 3 I has been my guiding principle to say, what do we do today without boiling the ocean or breaking the bank, no pun intended.
Does anybody want to comment on that or add to that?
So I just want to add one thing. So I think it's useful to think about why it's difficult to. One thing that crypto does really well is what I'll call censorship resistance. You have a system, nobody controls it, nobody owns it, you can't sue them. It sort of operates on its own, and that it does really well. Now, that doesn't mesh super well with traditional finance, because in traditional finance, you have fiduciary responsibility. You have to. So I think what Nitin and colleagues, or what a lot of people are trying to say, it's like, well, we want to continue to operate in a system where trust is based on. I think there's something really, really interesting in that universe where everything sort of trying to pick elements from that and say, well, what if I could combine? So far, nobody, as far as I can tell, has been able to actually do that. And perhaps they will, and if they will, that will be fantastic. But there's this difficulty in applying sort of the structure we understand well in a world where you have where everything operates on a fundamentally different level of trust. And one of the examples for why this is very difficult is what happened, as I understand it, in Australian securities tried to monetize itself asset, and on an effort to, and the post-mortem is that basically make that system operate the way it would operate best meant completely some actors who had very much role in it's very difficult. It's fundamentally different, and perhaps somebody will be able to at some point, but it hasn't been.
David, I don't want to put you on the spot. Do you want to comment on that?
Very briefly, I think, there's been a number of reports released into Australian securities exchanges to replace its +year-old chess system, which is the equity clearing and settlement system operated for a long period of time. It initially wanted, 2 years ago, they planned to replace it with a blockchain-based system, and this was very early days of blockchain hype, partnered with digital asset holdings and 7+ years, quite a lot of money, and effectively back at square one. And it was a project that was, I guess, by governance issues, but potentially also a blockchain is the solution to this problem, and it wasn't obvious that that was necessarily going to be scalable for the requirements that place chess. But there's probably a much better explanation of what went wrong. Read on the ASIC and RBA websites.
Well, thank you for that. I mean, I think one of the takeaways, as is always the case in the world of science, there's always a lot of experimentation and going this way and pivoting and going that way. And it may be that, you just don't know how some of these technologies are going to play out. But I think we have to remember what President Harker said yesterday, but they are out there and you can't put them back. It's not, to eliminate them, as to figure out how to manage the risks associated with them, but to try to use them as tools to get us to the next level. It was interesting, Fed Governor Christopher Waller also gave a speech in the last few weeks where he was talking about the importance of innovation. And it was a similar thing. You can't put the genie back in the bottle. And while some of these, whether it's AI, whether it's quantum computing, whether it's Web3, whether they have risks associated with them, but it's very important to find out what the benefits might be. And so I think for a lot of people struggling with digital assets and what value do they add, it might not be obvious how this will all play out, but I think there's a general consensus that this is worth still exploring, even if it's mostly the technology underneath it, and how that's used. But I want to just go back on the point on innovation. Nitin, I've taken the liberty to quote something you wrote because you're a prolific writer, but I thought this was very interesting. In talking about how is this ecosystem going to evolve, you said the evolution of digital assets and their related architecture will be a product of bottom-up innovation by market participants and top-down inputs by regulators and lawmakers. Is it working out? Is it moving ahead?
I would say I'm an eternal optimist, and I would say that it should work that way, only because if you look at all these piecemeal effort that we, our cohorts, and our clients, investment management community, asset managers are doing, eventually the dots will connect. And when the dots connect, then we realize, similar to the travel agent example, that we don't need all these intermediaries or counterparties that were introduced because of the risks that we've experienced in the past. And so you'll understand at that point that we don't need a lot of these existing sort of trust players who provide a specific function to the markets, but we still need financial institutions. We still need entities to enforce these fiduciary and prudential sort of requirements around the assets that are meant for safekeeping and the checks and balances that are systemic. I also think that it's not just going to be like Bitcoin is massively disruptive. It's a truly global system. It has global footprint. The cost structure are exactly the same. So if you look at the access to all the DeFi ecosystem on Ethereum, the access point is exactly the same if you're in the US or Vietnam or India, right? And so the question there becomes is, there's a value to that. There's value of access to some of those other elements. And in taking this in our context, which is regulated financial service industry, is what can we learn from that technology to be able to build that and get some clarity to say it's safe now to be able to deploy these technologies in a meaningful way and connect to the investment, and then figure out as to what can be replaced by pure tech, which is the trust system that Antoine was talking about, and how do we still preserve the roles of financial institution that provides the element of fiduciary and the prudential treatment of assets, I think.
Trick is how and can and will that be done? $1-million question.
There's a question I have, like, isn't that being done in a lot of parts of the world now through the regulations that are coming through? And it's, I mean, the U.S. seems to, at this point in time, be an outlier when it comes to regulation of the ecosystem and not taking those next steps for a multitude of reasons. And because of the global nature of this system, ultimately, like, the questions or what you said was the top-down input from the regulators is coming, and it's going to ultimately leave the U.S. behind or just continuing to try and play catch-up. But it is happening to the level that isn't necessary.
So can I discern between what you mentioned is absolutely right. Like if you look at some of the progressive, and I use the word progressive because they've taken the time to understand the system and have the regulation for crypto. So I don't want to discern between crypto finance, which is a separate sort of emerging asset class. I call it the fifth asset class. And I do want to recommend that we have enough regulation, as Antoine pointed out, too much in some cases, into the world that we live in, right? And so at that point, it's how do we apply technology to preserve those regulatory guidance? And does that technology reduce the cost of transactions? And if by reducing the cost of transaction, can we pass that on to our clients, right? And so by asking me to use a messaging system versus blockchain, I don't think there's if I'm using this in a permission manner, for instance, which is as a pure tech between our regulatory framing, I think it's okay. There is less, unless I'm using a public blockchain network, then the whole issue of resiliency and cybersecurity and all these things exponentially goes up, I think. But crypto, I completely agree. Crypto, what MAS has done, what Japan has done is very, very progressive. They've now gone the path of experimenting with the traditional securities on public blockchain, which is a whole different level of risk model framework that needs to be built around that. I think. I'll pause here to see if that made sense.
Absolutely. And I think you also mentioned, you touched on operational resiliency. That is such an issue even in the traditional financial world and clearly in this new digital world. And this is where the role of technology cannot be overestimated. It's very critical. And I think there's the technology for the good and for the bad or for the unknown. But we need to not throw the baby out with the bathwater. At this point, I'd love to open it up to questions. I have several more, but we'd love to hear from anybody around the table on questions for our panel.
We agree with you, Angel.
No, you are not going to, but I'm really a beginner on all this, so I'm going to ask a very naive question. That is, what is the problem that all this is trying to solve? We haven't been able to understand it. So let me ask it in a very precise way. What can we do today that we couldn't do without blockchain technology? Because my assumption is that the central bank digital currencies are not going to use. I could be wrong. So what is that we can do in the private sector that would be impossible to do? That is important, right? Beyond, you cannot buy Bitcoins. I understand that. But from the point of view of infrastructure, of payment systems, or smart contracts, whatever, what is that has become now established and that we wouldn't be able to do?
So if you look at the lens of payments in general, stablecoin, CBDC, digital fiat. I use the word digital fiat as a collective term. And you have payment system, MasterCard, Visa, and our now FedNow coming. These are all trying to remove the friction and bring more transparency to the system. Okay? I don't want to compare what blockchain is going to do for these, because I think we have a pretty good system. I agree with you. I don't want to take a lens, which I've been in this space for almost 14 years, trying to understand the implication of these various asset classes that are coming up. So I want to draw the attention, and it's a bad word in some communities like Web 3.0, is where we are going with. So it's not just about a asset class that can be tokenized, which to me has, as Antoine mentioned, we're trying to have a centralized focus on a system that is meant to be decentralized. So that's like a round hole in a square peg of sorts. So that is going to have its own friction from that perspective. If you look at Web 3, which is truly a global agenda of misinformation, disinformation, data, access to, live in the U.S., you don't have access to your healthcare record. Somebody else is really making money off that. It's $1 trillion problem globally, at least in the U.S. alone. So when you start looking at those, I've written about this topic too, there's a hyper-financialization of what is an asset. Look at bankable asset. These are the assets that you look at, your mortgages and the stuff that you can value, and we provide financial primitives around it. But you can't really value heirlooms and patents and some of these things which are hard and but they are personal in nature. Data, especially data in that case. If you start looking at that, then my ability to transform my tokenized version of myself in form of identity and own these assets that I can monetize in the digital ecosystem, I think that's where you're able to now have a truly global impact, that Ethereum and Bitcoin as networks truly have a nation-state status because they're trying to attract talent capital, and the DeFi ecosystems are truly financial innovation that's happening as we speak. I'm more attracted towards that if I can monetize my identity, monetize my healthcare records, and get a payment instruments. At that point, the notion of fungibility really differs drastically from a fiat model. I know it's a little off-field, but I just want to give that perspective to say, I don't want to take blockchain and use that as a hammer that every problem becomes like a nail. It is a transaction system, but I'll stop here. I don't know if that makes sense.
I mean, I think I agree mostly, but I'm going to frame it slightly differently. So there's one thing that we know that crypto does, and that I think 15 years ago people didn't think could be done, which is the censorship resistance. You can transfer value without needing to trust anybody. That is hugely valuable in some parts of the world. Like if you live in Afghanistan, you really can't trust anybody, and you can do with that things that you couldn't do before, and that has a lot of value. It's also very valuable if you're a criminal, incidentally, but that's a different one. In the U.S., the ability to transfer value without trusting anybody is not very useful because the transfer system that rely on trusted third parties are just much better. And so now people have said, okay, this system does something that's really, truly amazing. It happens not to be very useful in Europe and the U.S., but it's really surprising and spectacular. Are there elements of it that we can take out and mix the two together in a useful way? So far, nobody has shown that they could do it, but that doesn't mean it can't be done. And if it can be done, then perhaps it's really cool.
I agree with everything you said. I also do think it's important to look beyond just the financial aspects of these products. Like blockchain is in crypto, and you often hear like you can separate what blockchain does from crypto necessarily, but the function of blockchain is crypto is required for that to allow the truly trustless system to function. You need it, and while there is a secondary market created for those tokens, everything that is superfluous to what the underlying business prospects are of like an individual blockchain or business. So like supply chains, having the access to supply chains and what is going on at every step of the way, you just don't have in traditional understandings of it. Like you can't go and look, and you have to rely on what other third parties are telling you of like where your diamonds come from, for instance, and how far back it is. And you just go to your jeweler and you get the information that says, oh, this is from this part of the world. Okay, great. I'm going to trust you. With a blockchain aspect, you can go and you can look up all this information. You can see where those diamonds came from, what was the process every step of the way, and you can have the information yourself at your hands. So I think the same way with like real estate. I think there's a functionality upon real estate that the blockchain just lets it function in a better manner. So if you're able to apply the blockchain to a whole world of different things outside of traditional finance, that's when you kind of open your eyes to what it can make better.
On private lending and systemic risk element of private lending. One thing blockchain does, there's a whole element of token, and it is a transaction system, and most transaction system actually has a database. The blockchain essentially is a database of sorts. Is things that take like syndicated loans, 21 days. And for 21 days, there's little visibility of what's happening in settlement times, and that's come to light. So I think if you forget the token element of it, simply focus on shift from asynchronous dissemination of information to synchronous dissemination of information, suddenly I'm solving for reconciliation problems. And if I can just solve that, I'm sure we all would agree here that we'll solve a whole lot on the engines of the financial services industry, because we're spending a lot of time in batch processes, which is batch relay system of simply reconciling books. And if I can just solve that, forget the tokenization element of it, I think we still solve a lot of problems. But I know you've been looking, I don't know if you agree with that. I want to beat Angel's thing too. I agree with Nitin.
Yeah, I agree. I think there's a lot of information system issues that need to be solved. And then my question is that really a crypto/blockchain thing, or is it really just better information system? But absolutely.
A world before iPhones, and who thought they needed an iPhone? And I remember Steve Jobs, I won't get this correct, but he said something like, you know, we try to focus on what people don't know that they need. And it's also like the World Wide Web. Who thought you needed the internet? So it's not necessarily how it starts out and what's visible on day one. It's sort of how does it evolve to really be value added and help change for the better things that, you know, solve for things that need to be done, and at the same time, use it to find ways to mitigate risks. Technology also has huge potential in that regard.
Were you overhearing our conversation that Antoine and I were having literally right before the panel, because I made that exact analogy of it? I said, you know, yeah, like landlines were great. They functioned as they were supposed to. They advanced from having to call up and have a person plug you in to just being able to dial the number, and cell phones were great, and you were able to limited capabilities, and you can move around and talk. But the iPhone it wasn't solving a new problem, but it was building on it and creating a whole new structure. And I think if we were to have this conversation 3, 5, 10 years down the line, when we move beyond the financial and honestly, like the investment aspects of crypto and the fraud that's quite honestly around it, and still needs to get weeded out, because you have people like Sam Bankman-Fried and Celsius and BlackFi and other institutions going bankrupt. Like, once we get beyond those discussions, we can really start to like see what takes off around the entire ecosystem.
Are there any more questions out there? That was a great one. Angel.
So I agree with Angel, which is but really I wanted to kind of follow up on this. I guess 2 questions and a statement for further discussion. One is the notion that kind of what are we solving for? And Brian, some of the applications that you're describing, I think are actually the most interesting and promising, but it's not entirely clear to me why they're not really about the application of blockchain for, you know, like in trade policy, which is where there's a lot of interest in applying blockchain for traceability of the supply chain, or in the US where it comes to exchanging. Really haven't seen there, so I'm curious to kind of hear a little bit of why. But where I kind of wanted to also kind of double click on is this notion that there's a real utility in crypto in kind of the anonymization aspect. No, it's not entirely. But that part of the reason that you don't have an acceleration of adoption in fairly well-developed economies is exactly that you don't have a trust aspect. There is two factors about who's on each. And I would say this, I guess, coming from MasterCard, but there is a real value in an intermediary trust that you understand that that is applied to a financial transaction. And that's where kind of, I think, broader retail adoption of crypto starts to.
To go to your first one, I think ultimately it comes down to two things. One, just what I just said. Like, people right now are hung up on the investment aspects of crypto and dealing in the secondary markets and trading and everything. And so that's where the attention is. With that, we kind of need, the industry needs its ChatGPT moment, where AI was talked about forever, and no one was really like thinking of the possibilities or what is it going to do for me in my everyday life. ChatGPT came out, like 3 months ago, and it blew up and changed how we think about the world. And I honestly, and this is just my thoughts, I think crypto blockchain kind of needs that product to have that ChatGPT moment, because they're already being solved, those questions. There are plenty of businesses that are dealing and developing and have the asking these questions and answering them. But it's just going to take that one that allows it to hit and gain mass acceptance in the market, and what it does for an everyday user to really take off. And when that is, I don't know yet, but in what functionality form it will be, good question.
Let me throw one other thing out there. If we turn to dominating the headline, we had recently that tokenized assets go to 2027 number. So is that something that people are going to be focused on? What are the trends and the issues that you see in the next few years?
Sure, amongst that. So I would be super skeptical of predictions made by people who have a large amount of tokenized assets in the future. And I don't have a personal view on that. I guess I
don't have any stake in it.
What I find really striking, and I should say, since I've been so negative, my hope is that there's something really cool that comes out of all of this, right? So I'm not. But I'll make one more negative comment. There's a lot of really interesting things happening in the world of payments, right? So if you look at faster payment systems, they've completely changed the way they've made cash essentially disappear in some countries. Like, they've changed the way people pay. They've changed the way people operate. That's remarkable. None of this is crypto. Everybody's talking about crypto that has done zero for payments. It is a super cool idea. Perhaps something amazing will come out of it, and I hope it does. But when we talk about the future of payment, I think there's a lot of really interesting stuff that are happening that are making a difference. And with FedNow right around the corner, we can hope that in the U.S. there will be a lot more faster or instant payment system that will help change the way people do payment, and I think that's a really good thing.
You see more good coming out of the traditional world that is going to help take us to the future?
I think we have seen
okay.
More good so far, and then
and we have FedNow coming.
And we have FedNow coming, and then we can hope that the technology will prove to be super good. But even if it doesn't, there's a lot to look forward to when it comes to payments.
Hope for FedNow. Tips is an amazing product which nobody uses. I hope that this fate will not be shared by FedNow. But in terms of, I mean, you were more going into service provision, information sharing. In terms of payments, I think, and the payment system and the future of money, I think there is something in the developments which we can take out. And I think it's more the tokenization than I mean, I have to say I'm a central banker, so, I mean, there is an advantage in centralized systems. And I think I would be surprised if in the Eurozone we would end up with a digital center. I don't think that. Nothing is decided, everything's open, we'll have to figure out what it will look like, but I think it will be centralized. That's my first guess, but it might be tokenized. And, well, that's the first step, and it's just retail, but having a tokenized version which will allow a lot of things, and if you ask for practical applications, the security settlement, and that could be really so. I'm not trying to defend the prognosis which you just mentioned, but I mean, it's not fancy, and that's not cool, and that's not new, but it's so much cheaper, and it's so much easier, and you save so much work if you don't have all these payment people, of which I barely understand what they're doing all day long. But you would not need that anymore, and that would solve a lot of problems, because it's not just you need a lot of people, it's also messy, and it doesn't work a lot of the times. So there's a lot of merit, I think, in there. To me, the decentralized aspect and the DeFi aspect, to me, that freaks me out. And so we talked about Mika. That's something which is not in there. That's something we don't have. I mean, we have it on the radar, and we think about what should we do about it, but we don't yet have an answer there. And I think that is something, because you have problems in the financial system which arise from the open future, and that plays more into this sector than into any other. And that creates problems which we know for centuries, which will pop up in a decentralized world as they popped up in previous settings. And so therefore, I'm not sure whether there is, depending on how you set it up, a world which truly is decentralized like the Bitcoin is. I don't see that coming. But prognoses are always difficult.
That's part of next stage of work, I think, is to look at that. So all eyes will be on it. Yes. Brian, any thoughts?
Yeah, I'm interested in watching South Korea and how they roll out their tokenization of everything. Have a lot of good conversations over there, and there's a lot of high-level companies that want to literally tokenize everything. And you have current leadership that is fully on board with allowing that to happen, and trying to find ways for that to happen. So I think it'll be interesting to watch that over the next few years. From a obviously goes beyond the current audience, but I think how crypto and blockchain affect your personal data, as Nitin said, is a major thing that is going to occur over the next few years, and how it interplays with other industries. I mean, I think, there's a company that puts out, it's called Tiny Taps, and they allow tokenization for teachers to tokenize their studies and their classes and everything, and it allows them to have a system where they can obtain growth to be able to purchase supplies and everything for the classrooms. And that's just one example of going outside of the normal structures of the system to be able to find new ways to develop education systems, supply chains, real estate. We could go on, and it's important to look beyond. I just think, what effect does it have on the financial system? Because there's a lot of other applications out there.
I also heard that you're having tokenized lunch today because we're tokenizing everything. I'll actually go back to the history. 9 years back, the reason why stablecoins were born, to keep up with the velocity and the digitalization of the crypto industry per se, and not everybody could mine and have the technical acumen and do all these things. Let's go tokenize fiat because that's an easy way to have an on-ramp, off-ramp to move money, and then you just begin to value these assets. And if inverse were to be true, when we're tokenizing existing asset classes, what happens to? So I'll go back to what are people using to pay for things? What is true element of fungibility? And if you look at any of the 5 or 6 dominant layer 1 protocols, which are primary drivers of this technology, but also that was the ecosystem that are evolving on these, they are truly fungible systems. Bitcoin, Ether, these are fungible instruments. You can pay for Ether for things in the Ethereum ecosystem, bridges that you can move back and forth between these different sort of. So to me, I'm seeing, besides fiat, which was the primary source of what we value as money, going back to the point that if I can pay for things with my healthcare record, if I can pay for things with So I view not drinking the tokenization Kool-Aid, but I view as new avenues to treat fungible instruments and as to what we can do, both from infrastructure perspective, but also from instrument perspective, that comes to life. And I would say one more thing, that if I look at, like, I speak to my son, and his perspective of banking is just different altogether. And he want to be able to use his PayPal account or even Apple Pay account to be able to whether pay using crypto or using cash or using an instance of, Apple stock, for instance, because he chooses to use any of them as payment instruments, as opposed to going through the whole process of selling your equities and then translating that into fiat and then spending for fiat. And that mindset is an important aspect of how the next generation consumes financial services, I think.
I think it's very much how the next generation is going to think about this. I know we're bumping up and running out of time to lunch. I would love to have done a David Marsh and asked all the other central bankers here their views, but do any of you, Kartik, have anything you want to throw out real quickly from your perspective?
Yeah, so since you gave me the opportunity, I mean, it's never attractive to be standing, between somebody who's promising tech utopia and just feeling like a weird Luddite. But, in some ways, I wanted to go back to the past of money, because I was trying to think about, we got central banking not by accident. We got central banking in part because of innovations that happened in the way people tried to have IOUs that serve as money. And so throughout this discussion, I was thinking about, what have we learned from that in terms of the discussion of decentralized? The word decentralized means many things, but there was a relatively decentralized set of arrangements that have existed in the past. Also, tech is different, but the decentralization doesn't seem at least fundamentally different. And so I think for me, it's hard to think about this without thinking about how we got here in the first place, but that's more of a comment, I guess.
I'd like to add something really quick on that. So there's a lot of people are talking about how once you can tokenize everything, everything can become money. And perhaps that's true, but I want to offer that why are people paying with dollars and not treasuries? Well, the reason you're not paying with treasuries, if you're trading in treasuries, you're always worried that somebody is better informed than you, and they're going to be able to buy your treasuries at a price that's not very attractive. You don't have to worry about that when it comes to money. So if people start paying with stock or with houses, they're going to be worried that they're paying with somebody who has a much better understanding of that market, and then people will have an incentive of getting. So there's a reason why we pay with the way we pay, and this is related to Kartik's comment. And I think we should be very suspicious of this idea that everything is going to become money, because that's going to create a very rich ground for people to take advantage of others. And so I think it's good to go back to fundamental economics when we try to think about. So it's great to have a system where things can be exchanged more seamlessly. I think that will happen, and that's very, very good. I don't think that this necessarily means that everything becomes money.
I just last comment I'll make, I promise. I don't disagree. I will say though that with the advancements and the ability to have access to data that you generally did not have in the past, probably somewhat changes that equation. So if you have better understandings and better access to all the information that everyone else does, I mean, maybe that closes that gap. And I'm not saying like you're going to start trading and paying for things in treasury bills, but at least on some level, like your average person knows their own value of worth and controls their own data, controls what's going on in their system, so they're able to better, at least take a more calculated risk when it comes to that.
Your head, Jens, but we're going to have to bring this to a close, but I'll give you the last
I'll just say I disagree. No, it's nobody wants to process all these informations all the time. And the risks you're taking if you know that you're liable in terms of a contract which you have to serve in a nominal fixed amount by fluctuating asset values, I think that's not going to happen. So I stick with the central bank group here in that sense.
Well, let's just say there's lots more to come on this, so stay tuned. I think it's very much watch this space. There's a lot evolving and a lot happening, and I think if we keep our eyes open and willingness to consider new things, hopefully we'll get to a good spot where we see the benefits and manage the risks of these. In any case, thank you all so much. Great comments. Thank you to the audience and for your questions.